I have a question for you. Do you also have those days where you have no idea what the market is doing or what it even wants to do, taking loss after loss after loss, almost making you feel like you forgot how to trade, like you know nothing about trading anymore? Well, I certainly had that experience, and this is exactly how I overcame it, where I can now recognize that price action and I avoid it, allowing me to have a higher win rate and a higher return, avoiding unnecessary losses. The first thing we need to understand when we dive into the chart is the dollar correlation, the DXY correlation, which of course is the US dollar. As you may know, the US dollar currently is the world reserve currency, meaning that the foreign exchange market right there mainly revolves around whatever the US dollar is doing. So doing an analysis on DXY right there is quite important, because if you can see that the dollar is not moving and is consolidating, then you can already know that the majors right there that we are seeing on the right side of our screen, Australian dollar, US dollar, EU, GU, even the indices, they are more prone to eventually consolidate as well, because they are following the dollar right there. This saves us quite a lot of time, because instead of analyzing all those different pairs, all those indices, if we just take a look at the dollar and we can see that it's not in the right conditions, then we can already avoid all the majors and the indices right there. So what are these conditions that we are talking about? If we take a look at the dollar and we first go over the monthly time frame, then right there we have a monthly fair value gap. And by the way, I'm currently going to go over the highest probability days to trade. But later on in this video, we're also going to go over the highest probability sessions, the time windows to trade. First, the high probability days. Here we see the monthly fair value gap. And off of that monthly fair value gap, that is of course, as we know, a premium array. We can continue lower off of that potentially. Very easily said, that is a resistance area. So if we want to continue lower currently, then we will continue lower off of that fair value gap right there. But if we now zoom in to the daily time frame, then what are we seeing? Whilst pushing into that monthly fair value gap, we are also seeing daily fair value gaps higher right there. And we can also see that overall we have been bullish right there on the daily time frame, meaning that the bullishness was in control of the market. Higher prices were in control of the market. Bullish order flow was in control of the market. So when we then all of a sudden come into a higher time frame premium array like the monthly fair value gap, that doesn't mean we can just simply continue lower right now with ease. No, now there's a conflict where if we want to continue lower, this monthly fair value gap will be responsible. But we have been bullish. So if we want to continue higher, then the daily fair value gap right there will be responsible for higher prices. So if we want to continue lower right now, then we need to have a transition of order flow, meaning that the daily fair value gap and all the orders that might have been there to continue higher need to get transitioned into bearish orders. And to make that a little bit easier, this daily fair value gap right there, if we want to continue lower, will be the first resistance area. That is exactly the area where we will have conflict, where we will transition if we want to continue lower, where low probability conditions happen. That is where we consolidate, because now bearish order flow is trying to take control of the market, whilst bullish order flow has been in control. So in order for us to be bearish, we need to overtake this daily fair value gap, which is a discount array, which if we want to continue higher, this one will hold. So now that we understand that, that leads to a 50-50 area, because the high that came into the premium array and the low right there that came into the daily fair value gap, this area that we are currently in is a 50-50 area, meaning there is no high probability short opportunity, there is no high probability long opportunity. We will only consolidate right there until either the daily fair value gap right there decides to follow through, continuing higher, closing above that high right there, ideally with a new fair value gap continuing higher right there. That indicates that the monthly fair value gap is not strong enough to push lower. But on the other side, if the transition is completed and bearish order flow now starts to take control, then what we would want to see is a close below these lows right there, and ideally again, a new fair value gap continuing lower. That indicates that the daily order flow is not in control anymore and that the monthly fair value gap will want to follow through, or at least have a bigger rejection. Now, what you're also going to need here in a situation like this is patience. Trading requires a lot of patience. I'm also going to go over examples later on how you can capitalize on a situation like this and how you can profit off of it. But the highest probability price action does not happen in this 50-50 area right there. And a lot of traders don't even get the chance to trade the high probability conditions because they see a consolidation, or they might not even see it in the first place, and they try to trade it. They might take some losses, they might blow the account. And then after, when the high probability conditions do happen, they are most likely going to miss it. And again, when I say that, I am purely speaking from experience. Trading is not so much about winning as it is about avoiding to lose. Winning is not the difficult part in trading. Everyone can take a winning trade. Everyone can click buy or sell here and there, and they can once in a lifetime take a winning trade. But a lot of traders in between the winning trades don't know when to stay out of the market, which is arguably more important than knowing how to get involved in the market, which of course they go hand in hand. I think you understand that. And then if we dive into the lower time frame right there on the 4 hour, on the 1 hour, we can clearly see again the consolidation, where a consolidation is seen through fair value gaps, not creating new fair value gaps. And what I mean by that is, for example, right here, this fair value gap right there higher did not create a new fair value gap higher. It did not follow through. That is an indication of a consolidation, of seek and destroy conditions. And we can see a lot of fair value gaps right there that are not following through, that are not creating new fair value gaps off of the previous fair value gaps. This is extremely low probability price action that you want to avoid. But again, I'm also going to show you how you can actually capitalize on this. Now, once we understand that the dollar right there is not in a great condition until we either take out those highs or take out the lows, the action plan we talked about where we close below the lows or the highs with ideally a new fair value gap here on the daily time frame. Until that time, we know that all the pairs we saw are likely going to be low probability because they have US dollar in the name right there. So quickly in between, if the dollar is low probability to trade, then your eyes, if you're a Forex trader, should move to the crosses right here, which are not directly correlated with the US dollar. They don't have US dollar in the ticker name, because these, some of these right there, will more than likely have a very nice move. For example, GBP Australian dollar right there. Now the indices right there, you should know they are also affected a little bit less than Forex pairs, but you will see when the dollar is not trending, not having nice price action, the indices are also affected by that. The lower time frame might not be as nice anymore. All right, we talked about high probability days. We got an idea of how it works. I want to go over 3 more examples to show you how this is fractal. Not only high probability days, also high probability sessions, time windows, the smallest time windows that you can think of even. Right here on NASDAQ, we came above this high right there, creating overall a mitigation block. This is known as a fair value area. So if we want to continue higher right now, we will continue higher off of a fair value gap right there that is overlapping with the fair value area that we talked about in episode 1. Now that 1 hour fair value gap right there will be responsible for if we actually want to push higher. So if we want to continue with higher prices, then this 1 hour fair value gap right there will at least get a rejection higher. Towards what we talked about in the previous episode, the market maker models, this is the first target right there, the previous candle high. Then if we go into the 15-minute, one time frame below it, what will we see? We will see that we have a first resistance area in the form of the 15-minute, where the 15-minute right there creates a fair value gap. Now, most of the time, you will see me use a fair value gap. Sometimes it is a mix of a fair value gap and an order block, break block, whatever it may be. Most of the time, you will see me using fair value gaps because I also want to see fair value gaps going into the discount array that we are likely going to continue higher from and out of the discount array, creating the sharp turn. Then if we go into the 1 minute time frame to get a little bit of a better view, to get a bit more clarity. And here we have the 15-minute fair value gap and we have the 1 hour fair value gap right there. Now, price action is quite calm until we reach what? The first resistance area in the form of the 15-minute fair value gap. Because price action here has been bearish for a little bit, where all of a sudden the 1 hour right now is saying, hey, I want to take control. So we need to have that transition of order flow, which creates a very 50-50 area in the form of this area right there. But as you can also see, before we actually reach the 15-minute fair value gap, we have nice price action, very easygoing price action, a nice simple trend. That is exactly the price action you want to focus on right there. Until we reach that resistance area, that's when we get a big retracement, when all of a sudden price is doing those weird consolidations, until after we take out those highs again right there, above the 50-50 area. So again, the 50-50 area being this right there. We are very patient here and we know when to get involved. We know when the high probability price action happens right there. And we wait for a close above the 50-50 area high right there, ideally with a new fair value gap. Then that fair value gap sitting right there is exactly the entry we want to use, covering the most recent swing low, targeting the high that we had sitting right there. This in itself is an extremely high probability scalp, where you can see you need to have patience here, because if you don't have patience, you might not even get the chance to get involved in those high probability conditions, where again, I mentioned this in the previous episode as well. Low probability conditions feels like they last forever. And that's true because low probability conditions consolidate more, they have more ranges, they take forever to take people out of the market, where high probability conditions, if you blink, you miss it. So we don't want to blink anymore. We want to use those eye things to keep them open all the time. No, what we want to do is we want to use alerts in this scenario. So we know the 50-50 area right there, and we know we want a close above it. So the first step right there is identifying 50-50 area. Second step, close above it. Third step is fair value gap, ideally going above or below the low. In the meantime, of course, we can simply set an alert at these lows right there and at these highs. And when we trade above the high or below the low, we know it is time to act. It's time to do something. Where in the meantime, you can focus on something else. And believe me when I say, this is how trading is really done. When I trade, I don't trade a lot during the day. So any trading breakdown that I have on this channel, where I go about, I made this amount in a single day or whatever, I only look at the chart maybe for 30 minutes. That's it. I use alerts a lot of time. And the reason we want to use alerts is because the longer you are staring at a chart, the more likely you are going to do something that you should not do. So we need to limit our screen time, and we can do that by using alerts. And that will help us tremendously in our psychology. Now, NASDAQ right here is just the first example of the three. So let's go over the next one. Now, EU is directly and inversely correlated with the US dollar. So the chart is very similar to the first one we saw, the DXY, the US dollar. And then right here, we also have the monthly fair value gap. Coming into that, we have the same daily fair value gap sitting right there as well. But that's not the one I want to look at right there, because we already know about these conditions. We already know that is going to result in those low probability days. But if we go down time frames and we go into the 1 hour time frame, we already see the damage this price action is doing between the daily fair value gap and the monthly fair value gap, which we now have this overall 50-50 area, just a consolidating area on the daily time frame. But in between that, on the 1 hour right there, we see it's fractal because we have this 1 hour fair value gap right there that could follow through, right? Could potentially follow through, could continue higher towards these highs right there, towards the swing highs. So could be a nice trade opportunity overall. But what do we also see? When coming into the 1 hour fair value gap, we have an opposing 1 hour fair value gap right there, meaning a premium array, which is currently actually overlapping with an order block as well. And if we already have that resistance area on the same time frame, you do not necessarily need to go into the lower time frame right there. The only reason why you would go into the lower time frame is, for example, if we do not have that fair value gap right there, and if we need more clarity on when we can actually take a trade. Because right here, we can allow ourselves right now to go into the lower time frame, to the 15-minute, but I like using off of 1 hour PD rates, 5-minute or 1-minute entries. So 5-minute entries right there will look something like this, where this is again the first area of resistance. All right, we understand that by now. So what is the 50-50 area? This right here is that 50-50 area again. All right, the action plan. We set our alerts. Alerts above the highs, alerts below the lows right there. We wait for either one of them to go off. And when one of them goes off, we want to see a body close above those highs that we are currently having. And ideally a fair value gap right there going above the high. And in this moment in time, this is perfect because it's exactly overlapping with the high as well. It's the same as the Nasdaq example on the 1 hour that we saw. And that in itself is already an entry because now we are out of that 50-50 area. And when we are out of that 50-50 area, price is allowed to run because the transition is done. The conflict is over. That is exactly where you will see the highest probability price action, where price, as you may know it, will have low resistance liquidity runs, meaning it will happen very fast. And of course, as traders, we ideally want to see those fast runs of price action. Now, we understand the high probability days. Here we went over the day trading. In Nasdaq, we went over scalping opportunities. But I can potentially hear you think, but you just mentioned that on the dollar, we had low probability days, meaning that here on EU, with the same exact day right there that we just mentioned is low probability, you did take a trade. When you take a trade in those low probability conditions, and this is exactly how you can capitalize on it, because you don't need to sit still. You just need to pay more attention to these details. And you need to understand your trades need to be very short. And with short, I mean the time span of your trade should be very short. So ideally, a very quick in, quick out, like a scalp or a day trade right here on the 5-minute, capitalizing on those small moves. And that is how on those low probability condition days, you can capitalize, but be careful. Don't get too crazy with that. You still need to understand it is indeed lower probability. So you also want to lower your overall risk. All right, the last example, US dollar JPY right here. Daily fair value gap going higher, which we might continue higher off of. We also see that we are actually coming off of a premium array. So small little detail, because we are wicking that premium array, that is a sign of respect since we are not closing above it, meaning that is exactly when you can expect a deeper retracement into a fair value gap like that. Not only a sting to then continue higher. No, we have a deeper retracement because we are respecting a premium array right there. Now, we have a daily fair value gap right there as well. But before we even created the daily fair value gap, we on the 4 hour already saw this 4 hour fair value gap sitting right there, which we came into, which is the first resistance area, which again creates that 50-50 area. The transition of order flow is there. The conflict is there. So when we go into the lower time frame, into the 15-minute, because I like to enter off the 15-minute when we come into a daily PD ray, then this area that we are seeing right here is the 50-50 area. And you can see we have, or we actually come below the 50-50 area low right there. But we do not close below it. We have a fair value gap below it, but we do not close below it. And again, the same story that I just told you on the daily, right there. When we wick the low, we are respecting it, meaning that we will likely not follow through, continuing lower, but we will do the exact opposite. So we are sweeping the low instead of running the liquidity. And then after that, we can see then we close above the highs again. And when we close above those highs, that's exactly when we have that fast price action continuing higher towards the highs, which on the daily were just, again, our context highs sitting right there. And this is exactly how you can avoid being trapped and how you can avoid unnecessary losses, where essentially the longer you wait right there, the more you will get rewarded. Patience pays, always. This is arguably the most important part of trading, knowing when and where you want to get involved. Because avoiding those losses, of course, will allow you to have extra winners, will increase your win rate, will increase your overall return. Just a quick update, the spring enrollment will start the 1st of March. Now, the applications are currently ongoing for the spring enrollment. So if you want to be a part of that spring enrollment, then please feel free to go to arjo.io and you can fill in the application right there for the monthly option, and we will notify you if you are being selected. All right, perfect. Thank you.